Think about the foundation of the modern world. Usually, when we imagine the pillars of our economy, we look up.
Right, the visible stuff.
Yeah, exactly. We look at the concrete of the skyscrapers, or we look at massive steel suspension bridges. We look at the heavy infrastructure dominating the skyline.
Because there's this ingrained expectation that the most important structural elements of our society are the ones taking up the most physical space.
Right. If you can touch the steel beams, or if you can drive a car over the asphalt, it feels like the true foundation of civilization.
But that paradigm is, it's completely fracturing right now.
It really is.
Yeah.
Because when you step into the reality of the 2026 economy, when you look at the energy transition, the mass deployment of electric vehicles, and the absolute explosion of artificial intelligence. Let me rephrase that. When you look at all of that, the physical skyline is just a shell.
Yeah, it's just the housing.
Exactly. We are looking at a completely different foundational landscape now.
Great.
It's an invisible infrastructure. It's hidden entirely behind the drywall, or it's buried in subterranean conduits, or packed into server racks.
And tying every single piece of that future together, acting as the literal nervous system for this invisible infrastructure, is one very specific, highly conductive reddish gold metal.
Copper.
Copper. You cannot expand the global power grid by a single megawatt without it. You can't manufacture the millions of electric vehicles rolling off assembly lines without it.
Right.
And perhaps most pressingly, you absolutely cannot power the massive multi-billion-dollar AI hyperscale data centers, the ones currently dominating the tech sector's capital expenditures, without just astronomical amounts of it.
So if you walk into a newly constructed 1 gigawatt AI data center out in the desert somewhere, you aren't just looking at silicon chips.
No, not at all.
You're looking at thousands of miles of tightly wound copper wire. You've got massive copper bus bars thicker than your arm carrying megawatts of raw power, and intricate cooling systems relying on copper's thermal conductivity.
And the global demand metrics for this are just staggering.
They really are. As we look at the data today, London Metal Exchange copper prices are up 12% this year alone. They're sitting at a highly robust $6.30 per pound.
Which is massive.
Yeah. And global inventories. They're exceptionally tight. The world is incredibly hungry for this metal, and the global cupboards are looking dangerously bare.
And, the financial reflection of that tight inventory is exactly what we're seeing in the corporate data today.
Right, which brings us to the mission of today's deep dive. We are pulling back the curtain on Freeport-McMoRan, ticker symbol FCX.
One of the undisputed titans of global copper production.
Exactly. We're digging through their latest Q2 2026 earnings call transcript. And by traditional metrics, their execution right now is phenomenal. I mean, they just posted their highest U.S. earnings in a decade.
Yeah, their consolidated net income for the first half of the year jumped a massive 65% year over year.
65%. But, and here's the hook, if you're holding this stock, or if you're looking at the chart right now trying to decide if it belongs in your portfolio, you're probably wondering why the valuation isn't reflecting a pure, unadulterated moonshot.
Because there's a massive catch.
Right. And that brings us to the central tension of this entire analysis. Management revealed that the cost of physically expanding their massive domestic footprint to meet this global demand is skyrocketing.
They are facing seriously ballooning capital expenditures.
Yeah, specifically citing a 30% cost increase on a critical domestic mine expansion due to severe labor shortages and inflation. So we have killer margins colliding head-on with terrifying future expansion costs.
So to understand if this is a screaming buy or a value trap disguised by a commodity cycle peak, we really have to tear into the actual mechanics of their business.
We have to look at the scorecard of how their financials stacked up against Wall Street's expectations, and more importantly, the underlying physics and engineering of how they are physically pulling this rock out of the ground.
Absolutely.
Okay, let's unpack this and start with the headline numbers. Before we look at how they are mining the copper, we have to look at the scorecard.
Right.
The 65% jump in net income is a massive leap in profitability for a company of this immense size. But the number that dictates the survival and prosperity of any mining company, the metric that analysts build their entire financial models around, is the unit cash cost.
Yeah, and for anyone new to mining data, the unit net cash cost is the answer to a fundamentally simple question. How much physical money does it cost Freeport-McMoRan to blast, haul, crush, and process exactly 1 pound of copper and get it ready for market?
Right, because if you know they can sell a pound of copper for $6.30,
yeah,
and you know exactly what it costs them to produce it, you instantly understand their profit margin.
Exactly. So going into this quarter, the consensus Wall Street estimate modeled that it would cost them $1.95 to produce a pound of copper.
And they beat it. They reported a unit net cash cost of just $1.90 per pound.
Which is incredible.
It is. But wait, if you're an investor looking at the broader macroeconomic environment, that $1.90 figure should immediately trigger some skepticism.
Oh, for sure.
We are living in a world of massive inflation. Global energy prices, particularly the industrial diesel fuel that serves as the absolute lifeblood of heavy mining equipment, have been incredibly volatile.
Labor costs are up. Steel costs are up.
Yeah. So how is it physically possible to mine a pound of rock, process it, and ship it for under $2 when every underlying input cost is surging?
The answer lies in the specific geological lottery of their mine sites. I mean, Freeport isn't just a copper miner.
What do you mean?
Well, when they blast a massive wall of rock in the Americas or down in Indonesia, they are not pulling up pure copper, they're pulling up complex polymetallic ore bodies. So alongside the copper, they're extracting substantial commercially viable quantities of gold and another incredibly critical industrial metal called molybdenum.
I want to pause on molybdenum for a second because it rarely gets headlines, but it is a cornerstone of modern infrastructure. It's an element, atomic number 42, with an insanely high melting point.
Exactly. Molybdenum, or moly as the industry calls it, is primarily used as an alloying agent in steel.
Right?
When you add just a tiny percentage of moly to steel, you exponentially increase its strength, its heat resistance, and its ability to withstand extreme corrosive environments.
You find moly in high-pressure oil and gas pipelines, structural beams for skyscrapers, and the internal components of wind turbines and nuclear reactors. It's a highly specialized, highly demanded metal.
So here is the financial magic trick. This is the mechanism that drives their cost down to that $1.90 mark.
Okay, lay it out for us.
In their corporate modeling, Freeport is estimating gold prices to hold flat at around $4,000 an ounce, and molybdenum to hold strong at around $30 per pound.
Which are great prices.
Very strong. So when they refine the copper, they separate out the gold and the moly and they sell them into the global market.
Right.
They then take the revenue from those entirely separate sales and subtract it from the operational cost of running the copper mine. These are known in the industry as byproduct credits.
And the scale of this subsidization is profound. During the call, management laid out the sensitivity metrics. Did you catch the number on moly?
Yeah. Just a $1 per pound change in the global price of molybdenum equates to an $85 million swing in Freeport's annual EBITDA.
$85 million.
From a single dollar move. It injects $85 million in pure cash flow. So when you stack the robust, elevated prices of gold and moly on top of each other, the revenue generated completely subsidizes the rising cost of diesel and labor.
Which is what drives their net cost to produce a pound of copper down to that $1.90 spark.
Exactly.
I always try to visualize byproduct credits like this. Imagine you have to commute an hour to work every day in freezing weather.
Okay, sounds miserable.
It is. You have to buy a heavy winter coat, you have to pay for the gas, you have to endure the terrible traffic. It's a costly endeavor. But every single time you put your hand in the pocket of that winter coat, you find a crisp $50 bill.
I like this commute.
Right. The commute still takes the same amount of time, the gas still costs money, but that constant, predictable influx of found money essentially subsidizes your entire cost of living. It transforms a burdensome commute into a highly lucrative daily activity.
That's a perfect analogy. And that structural advantage allows them to generate a breathtaking amount of free cash flow, which they are aggressively funneling back to the people holding the stock.
Yeah, they adhere to a very strict, disciplined corporate policy of returning 50% of available free cash flow to shareholders.
In the first half of 2026 alone, that equated to $600 million, including about $200 million in direct share buybacks to shrink the float.
But what I found even more fascinating than the buybacks was a very quiet, strategic capital allocation move they made down in South America.
Oh, the Cerro Verde move.
Yes, they went into the open market and opportunistically bought more shares of their own Cerro Verde mine in Peru. Over the last 2 years, they've deployed over $300 million to creep their ownership stake up by roughly 2%, bringing their total controlling interest in that specific mine to over 55%.
And you know, from a game theory perspective of capital allocation, that is a masterstroke.
Really? Why is that?
Well, Cerro Verde is a crown jewel asset. It is a massive, low-cost, multi-decade operation. If you're a mining executive with excess cash, you basically have a choice.
Okay.
You can go out into the wild and try to buy a brand new, unproven mine from some junior exploration company, but that involves immense geological risk, unknown political variables, and integration headaches.
Or you buy more of what you already know.
Precisely. By buying a larger piece of an asset they already operate, they take on zero geological risk.
That makes total sense. They already know the exact composition of the ore.
They already have a relationship with the local labor unions, and they understand the Peruvian political landscape perfectly. It is infinitely less risky than greenfield exploration, and it's immediately accretive to their bottom line.
I see the logic of the capital allocation, and the byproduct credits are a fantastic buffer. But I have to push back on the fragility of this $1.90 per pound cost structure.
Go for it.
If we look at the macro geopolitical board right now, it's highly unstable. Management explicitly acknowledged the volatile situation in the Middle East on the call.
He did, yeah.
So if a geopolitical shock sends industrial diesel prices up another, say, 40%, and simultaneously, let's say the macro environment shifts and gold takes a sudden $500 an ounce dip, doesn't that $1.90 cost structure evaporate overnight?
It would certainly take a hit.
Aren't they essentially balancing their entire operational margin on the knife edge of lucky commodity pricing?
What's fascinating here is if they were a simple dig-and-ship mining operation, yes, they would be incredibly vulnerable to that exact scenario.
Because energy volatility is the traditional Achilles heel of heavy industry.
Right. However, Freeport has architected a structural defense mechanism deep within their supply chain that acts as a profound financial shock absorber. They are a fully integrated producer.
Meaning they control the entire life cycle of the metal. They don't just dig up the crushed rock and sell it. They run it through their own refineries.
Exactly. They operate massive, complex smelting facilities. And to understand how this hedges their energy risk, we have to look at the chemistry of smelting.
Okay, take us back to chemistry class.
When you take raw copper concentrate, which is essentially a dirt powder containing copper, iron, and sulfur, you have to apply intense heat and chemical reactions to separate the pure copper.
Right.
During that violent thermal process, the sulfur in the rock binds with oxygen, creating massive quantities of sulfur dioxide gas. Now, in the old days, that gas just went straight up a smokestack.
But today, modern environmental regulations require them to capture it.
Exactly. And when you capture sulfur dioxide and treat it with water, you get sulfuric acid.
A highly concentrated, highly valuable industrial chemical.
Yes. Freeport produces millions of tons of sulfuric acid as a direct, unavoidable byproduct of making copper. And they turn around and sell that acid to chemical manufacturers and the agricultural fertilizer industry.
Oh, wow. Right.
Now, think about the macroeconomic relationship here. What is the primary input cost for making most industrial chemicals and fertilizers?
The fossil fuels, natural gas and oil.
Exactly. So when global energy prices spike due to a conflict in the Middle East, the cost of manufacturing chemicals globally spikes with it. This drives the market price of sulfuric acid through the roof.
Oh, I see where you're going with this.
So yes, Freeport is suddenly paying much more to put diesel in their massive haul trucks, but simultaneously, the massive volumes of sulfuric acid they are producing as a waste product are suddenly selling for a premium on the open market.
The revenue from the acid sales offsets the rising cost of the diesel.
You got it. Management noted this integrated setup creates a natural built-in financial hedge that insulates their margins in a way that non-integrated mining competitors just cannot replicate.
That is brilliant balance sheet engineering. It essentially nullifies the energy risk.
It really does.
But, financial engineering and byproduct subsidies can only carry a company so far. If you want to maintain killer margins long-term in an inflationary environment, you have to physically change the mechanics of how you move the earth.
Right, you can't just rely on accounting.
Exactly. You have to innovate at the ground level. And that is exactly what we are seeing play out across their massive footprint in the American Southwest.
This is where we shift from the financial spreadsheet to the physical reality of the mine site. Meeting the impending tidal wave of global copper demand requires either finding completely new copper deposits, which is incredibly difficult, or inventing ways to extract significantly more copper out of the deposits you already control.
So let's focus on the United States, specifically what management has dubbed their Leach Everywhere initiative.
Great, Nick.
But before we get to the chemistry, we need to translate a very specific piece of Wall Street terminology they used heavily on the call. They talked extensively about brownfield expansion versus greenfield expansion.
Yes, very important distinction.
Why does that distinction matter so much to someone analyzing this stock?
It is arguably the most critical distinction in the entire mining sector right now. A greenfield project is exactly what it sounds like. You find a greenfield, an untouched piece of wilderness with a proven copper deposit underneath it, and you start from absolute scratch.
And starting from scratch in 2026 is a logistical nightmare.
It's a 10 to 15-year gauntlet. You have to conduct exhaustive multi-year environmental impact studies. You have to secure local zoning rights, navigate indigenous land claims, and fight for water rights in arid regions.
And that's just the paperwork.
Right. Then, assuming you actually get the permits, you have to physically build the infrastructure. You have to pave highways into the wilderness, string massive high-voltage power lines across miles of terrain, build the processing plants, the worker housing, everything.
So you're spending, what, billions?
You can easily burn through $5 billion in an entire decade before you produce a single commercially viable ounce of copper.
Which brings us to the alternative, brownfield.
Exactly. A brownfield expansion is taking an existing operational mine and scaling it up or applying new technology to the existing footprint.
So you've already fought those battles.
Yes. You fought the environmental battles 20 years ago. The permits are active. The workforce is already clocking in every morning. The power lines and highways are already built. You are just optimizing what is already there.
Which saves billions of dollars in initial capital, and it shaves a decade off the timeline.
Exactly. And almost every single major growth vector Freeport is currently executing is a brownfield optimization.
And the undisputed crown jewel of their U.S. brownfield strategy right now is the Morenci mine in Arizona. Management dropped a production statistic on this call that genuinely shocked me.
A 30% number.
Yeah. Yes. During the second quarter, the physical mining rates at Morenci, the sheer volume of rock they were moving every single day, was 30% higher than the average rate they achieved over the entire preceding 5 years.
Sustaining a 30% jump in material movement at a mine the size of Morenci is a monumental logistical triumph.
How do they even do that? You don't get a 30% increase by just asking the drivers to work faster.
No, it's the direct result of a massive technological upgrade. They are systematically replacing their traditional fleet with ultra-class autonomous haul trucks.
We're talking about 400-ton vehicles.
They're monsters.
For context, 400 tons is roughly the weight of a fully loaded Boeing 747 aircraft. So imagine a Boeing 747 with a dump bed on the back, navigating the steep, treacherous dirt roads of an open-pit mine entirely driven by software.
It's wild, and they are bringing online more than 20 of these autonomous behemoths over the next year.
And the efficiency gains must be huge.
They're compounded across several vectors. First, you eliminate shift changes. A human driver needs breaks, lunch, and a shift change that can leave a truck idling for an hour a day. An autonomous truck runs 247, only stopping for fuel and maintenance.
And I imagine the maintenance costs plummet as well.
Drastically. A human driver, no matter how skilled, will occasionally brake too hard, accelerate too aggressively, or take a corner slightly too fast.
Which grinds the gears and shreds those massive multi-$1,000 tires.
Right. But the autonomous software drives with robotic precision. It optimizes the torque on every incline, vastly extending the lifespan of the engine components and the tires.
But maximizing the haulage is only the delivery mechanism. Here's where it gets really interesting. The true breakthrough happening in Arizona is happening at the molecular level, in the chemical leaching process.
This is the Leach Everywhere initiative.
Yeah, and it is a fascinating shift in how we think about waste. For decades, copper mining has been a binary game based on grades. You blast a wall of rock. If the rock is high grade, meaning it has a high concentration of copper, you load it onto the trucks and take it to the concentrator.
And the concentrator uses massive, energy-intensive grinding mills to crush the rock into a fine powder so you can extract the metal.
But crushing rock requires an immense amount of electricity and steel grinding balls. Wow. It is very expensive.
Very.
So if the rock is low grade, meaning the copper is there, but it's so sparse that it would cost more in electricity to crush it than the copper is actually worth,
yeah,
you don't process it. You simply dump it into massive artificial mountains called stockpiles.
And over the last several decades, Freeport has accumulated billions of tons of these low-grade stockpiles sitting under the Arizona sun.
Which historically were viewed as zero-value waste.
Exactly.
But Freeport is deploying internally developed chemical technology, which they call Gen 1 and Gen 2 additives, combined with geothermal heated solutions to extract copper from these dormant piles.
And the science here is brilliant.
Let me try an analogy to explain the chemistry happening here, because traditional leaching is notoriously slow and inefficient.
Go for it.
Think of traditional high-grade copper mining like brewing a premium cup of coffee. You take the fresh beans, you grind them up, you pour boiling water over them, you extract a fantastic cup of coffee, and then you throw the wet, depleted coffee grounds into the compost bin.
Right. So the high-grade ore goes to the mill, the coffee goes in the cup, and the waste goes to the pile.
Exactly. For decades, these low-grade stockpiles were essentially just millions of tons of discarded wet coffee grounds. You might get a faint trickle of brown water if it rained on them, but they were largely useless.
Just sitting there.
But this new leaching technology, these Gen 1 and Gen 2 additives, it is the equivalent of a scientist figuring out a way to take superheated water, mix it with a highly specialized proprietary enzyme, and run it back through that massive pile of discarded grounds in your compost bin.
Okay, I see where this is going.
And suddenly, that enzyme is breaking down the cellular walls of the grounds, and you are extracting a massive secondary pot of premium coffee for absolutely free.
The chemistry behind your analogy is spot on. In copper ores, particularly chalcopyrite, the copper atoms are locked inside a complex crystalline structure with iron and sulfur.
Right.
Traditional weak acid leaching struggles to break that bond because a protective passivation layer forms around the rock, shielding the copper.
It basically seals it in.
Exactly. These Gen 1 and Gen 2 additives act exactly like that enzyme in your coffee analogy. They chemically strip away that protective layer, allowing the acid to penetrate deep into the rock and dissolve the copper into a liquid solution, which is then collected at the bottom of the pile.
And the geothermal aspect, why add heat?
That is basic thermodynamics. The Arrhenius equation dictates that chemical reactions accelerate exponentially with heat. By drilling into natural geothermal heat sources and injecting hot fluids into the stockpiles, they dramatically speed up the reaction time of the enzymes. The financial implications of this free coffee are staggering. By simply applying these chemicals and heat to rocks they already paid to dig up 20 years ago, they are targeting a 300 million pound run rate of new copper by the end of this year.
300 million pounds of copper generated without digging a single new hole, without buying a single new haul truck, and without asking the EPA for a single new environmental permit.
It is pure, ultra-low-cost margin expansion.
It's incredible.
And management believes this technology could eventually scale to produce 800 million pounds per annum long term. If they achieve that, they are essentially engineering the equivalent of a brand new world-class Tier 1 copper mine entirely out of their own waste.
It is arguably the highest return, lowest capital intensity growth project in the entire global mining industry right now.
I would absolutely agree with that.
It's a phenomenal engineering victory in the United States. But as we pivot our focus across the Pacific to Indonesia, to the legendary Grasberg mine, the operational turnaround is even more dramatic and honestly vastly more physically perilous.
Grasberg is a geological anomaly. It is one of the richest copper and gold deposits ever discovered, situated high in the remote, rugged mountains of Papua, Indonesia.
And it used to be an open pit, right?
For decades, yeah, it was a massive open pit mine. They literally carved a mile-wide crater into the top of a mountain. But a few years ago, they hit the economic bottom of the pit. The easy, accessible ore was gone.
So what do? You can't just pack up and leave?
No, because to access the massive deposit of copper sitting beneath the pit, they had to transition from open-air surface mining to a highly complex underground technique called block caving.
And for the retail investors who aren't familiar with mining engineering, block caving is one of the most audacious things human beings do to the earth.
It really is.
Instead of digging a hole from the top down, you tunnel hundreds of meters underneath the solid ore body. You blast away the foundational supporting rock, creating a massive empty cavern. And then you step back and allow gravity to do the work.
Right, the sheer weight of the mountain above causes the ore body to collapse in on itself.
Exactly. It fractures the rock into manageable pieces that funnel down through engineered chutes directly into your underground train system.
You are utilizing gravity as your primary crushing mechanism. Once a block cave is successfully initiated and running, the operating costs are incredibly low.
But setting it up?
The geotechnical challenge of engineering a controlled collapse of a mountain without the entire system failing is immense. And the massive headline from this earnings call is that the Grasberg Block Cave has finally conquered those challenges and is hitting its stride.
The numbers they put out were wild.
Production at the Block Cave absolutely doubled from 34,000 tons of rock per day in April to a staggering average of 69,000 tons per day in June.
Doubling production in 3 months on a subterranean system that complex is a massive operational win.
Huge win.
But, I read the Q&A section of the transcript very closely, and I have to challenge the risk profile management presented here.
Okay, what caught your eye?
During the call, they were celebrating their ability to navigate what they termed wet and dry draw points. Now, a draw point is the physical funnel where thousands of tons of crushed rock flow down into the extraction tunnels.
All right.
If that crushed rock gets heavily saturated with water, it turns into a dense, highly pressurized mud. And a mud rush in an underground mine is one of the most catastrophic events possible. It bursts through the extraction tunnels, destroys multi-million-dollar equipment, and most tragically, it costs lives.
You are identifying the single greatest existential threat to the Grasberg operation. Water is the ultimate enemy of a block cave system.
And management explicitly admitted on the call that the primary reason they had so many favorable dry draw points over the last quarter was because the El Nino weather pattern gave that specific mountainous region of Indonesia an unusually dry season.
They caught a break from the weather, basically.
Right. They got lucky. So my question is, when El Nino inevitably ends and the torrential, highly predictable tropical rains return to Papua, isn't this entire underground cave system destined to become a wet, muddy, logistical nightmare all over again? Aren't they essentially just getting bailed out by temporary weather patterns?
If they were relying solely on the weather, yes, the stock would be uninvestable based on that risk alone.
Because the rain is coming back.
The geographical reality is that the old open pit sits directly above the new underground cave. When the tropical rains hit, that mile-wide crater acts like a massive satellite dish, capturing millions of gallons of water and funneling it straight down through the fractured rock into the cave below.
And a valve at the bottom of a million-ton column of wet mud doesn't solve the problem, right?
Yeah.
You can't just cap it because the hydrostatic pressure from the water above will eventually rupture the rock or blow out the valve entirely.
Exactly. You're just trapping a bomb.
So what are they doing?
You cannot fight hydrostatic pressure with a simple mechanical valve, which is why management's mitigation strategy is a massive two-pronged engineering assault. First, at the extraction level, they're installing advanced technology called spillminator chutes.
Spillminators. Sounds like a movie.
It does, but they're highly serious. These are not simple valves. They are highly complex, automated mechanical draw points equipped with sensitive moisture and pressure sensors.
Okay.
If the sensors detect that the material flowing down is crossing the threshold from dry rock into highly saturated mud, massive hydraulic guillotine doors slam shut instantly, isolating that specific draw point and preventing a mud rush into the active tunnels.
Okay, so the spillminators are the failsafe at the bottom. They act as blast doors.
Yeah.
But to your point, you still have to deal with the water pressure building up from the top. How do you depressurize a mountain?
This is where they are deploying incredible capital and engineering muscle. They are aggressively drilling massive drainage networks to siphon the water completely out of the system before it ever interacts with the active production zones in the cave.
Just drilling holes.
But historically, drilling deep holes through heavily fractured, highly stressed rock is incredibly slow. The old drilling rigs could maybe push through 5 to 10 meters of rock a day.
Which isn't fast enough to outpace a tropical wet season.
Right. So Freeport is currently commissioning state-of-the-art, high-capacity drilling rigs specifically designed for this extreme geotechnical environment. These massive rigs can bore well over 100 meters a day, utilizing a much larger diameter hole.
So they are essentially drilling giant vertical drain pipes deep into the rock above the cave.
Giant vertical drain pipes combined with new horizontal drainage galleries. They are blasting dedicated tunnels along the north side of the pit bottom whose sole purpose is to act as storm drains.
Wow.
They're even investigating dropping massive industrial-scale surface slurry pumps down into the lower levels of the pit to physically pump the water out before it can seep down.
It's a massive undertaking.
The overarching corporate goal is to hit 80% extraction capacity at Grasberg by mid-2027, and they are spending whatever capital is required to ensure that when the torrential rains inevitably return, that massive volume of water is captured and diverted completely away from the block cave.
The risk is ever present, but they are engineering an incredibly robust defense mechanism that is currently executing exactly on schedule.
Precisely.
So if we pull back and look at the operational landscape, we have advanced chemical leaching in the American Southwest, essentially printing free copper out of waste rock. And we have the successful stabilization and doubling of production at the highly complex Grasberg Block Cave in Indonesia.
It's impressive.
Squeezing this level of operational efficiency and margin out of existing assets is an incredible feat. But as we pivot to the future, to management's guidance on what comes next, we have to confront a very harsh economic reality.
The cost of building.
Yes. You can't meet the massive looming tidal wave of global electrification demand solely by leaching old stockpiles and optimizing existing caves. Eventually, you have to physically build new, massive mining infrastructure. You have to pour new concrete and erect new steel.
And as management's future guidance laid bare on this call, building anything of scale in the year 2026 is brutally, punishingly expensive.
We are definitively operating in a new macroeconomic epoch.
The era of zero interest rate policies, cheap capital, and abundant cheap labor is just over. And nowhere is this inflationary reality more glaringly apparent than in Freeport's highly anticipated plans for the Baghdad mine in northwest Arizona.
Let's talk about the sticker shock at Baghdad. Freeport is nearing a final investment decision on a massive, multi-year expansion of the Baghdad operation. The strategic blueprint is to basically double its processing capacity,
which would elevate Baghdad to become the second largest copper mine in the entire United States, trailing only their Morenci operation.
And the geopolitical and strategic value of this specific expansion cannot be overstated. As global tensions rise and supply chains fracture, having a massive, highly secure, Tier 1 copper asset located entirely within the sovereign borders of the United States is an unparalleled advantage.
It absolutely is. It secures a vital domestic supply chain for the critical minerals necessary for the U.S. energy transition and national defense.
That is the compelling strategic narrative. The bad news, however, which caused a highly noticeable ripple of anxiety among the institutional analysts dialing into the call, is the actual price tag required to build it.
It was a tough pill to swallow.
Management revealed that their updated preliminary capital expenditure estimate for the Baghdad expansion has ballooned to $4.5 billion.
To put that in context, that is a staggering 30% increase from the original capital estimate they provided to the market just back in 2023. A $1 billion cost overrun before you have even poured the first cubic yard of concrete is the kind of financial shock that routinely destroys corporate balance sheets.
And when pushed on the call, the reasons management provided were almost entirely macroeconomic and structural.
What did they point to specifically?
There is massive commodity escalation. The sheer cost of the steel, the copper wiring, the concrete, and the specialized processing equipment required to build a massive new concentrator facility costs vastly more today than it did 3 years ago.
Right.
But the really sticky, seemingly intractable issue driving these costs is human capital. The labor market in Arizona is wildly constrained.
What's fascinating here is how different technological megatrends are aggressively colliding in the Arizona desert. I mean, Freeport isn't just competing with other mining companies for labor.
Not at all.
Over the last few years, Arizona has become ground zero for a massive American industrial renaissance. You have multi-billion-dollar semiconductor fabrication plants being constructed by giants like TSMC and Intel.
Right. The Teach-8PS Act money is flowing in.
Exactly. And simultaneously, you have massive hyperscale data centers being erected by Amazon, Google, and Microsoft to support the AI boom.
Which creates a massive bottleneck for specialized labor. Let me use an analogy to frame what this feels like for Freeport's procurement team.
Okay, let's hear it.
Imagine you live in a very wealthy, rapidly expanding neighborhood, and you decide you want to build a sizable addition on the back of your house.
Okay.
But right down the street, 3 different tech billionaires are simultaneously building sprawling mega mansions. They have infinite capital, they're behind schedule, and they're willing to pay triple the going market rate to lock down every single master plumber, specialized electrician, and heavy concrete pourer in the entire county.
You are instantly dragged into a brutal, unwinnable bidding war for talent.
Exactly. So what does this all mean? If Freeport is attempting to build a $4.5 billion industrial facility, they need thousands of highly skilled tradesmen. If they are fighting Intel and Amazon for the guys who turn the wrenches and wire the high voltage panels, won't those labor costs just continue to spiral out of control?
It's a massive concern.
Is a $4.5 billion expansion project even economically viable when you are structurally forced to overpay for the labor required to build it? Is the juice still worth the squeeze at these inflated levels?
It is the most important question for long-term investors. But if we connect this to the bigger picture and analyze the unit economics and the long-term modeled returns, the answer is a definitive yes. The juice is absolutely worth the squeeze, even at a massive premium.
Really? Even at $4.5 billion?
Management explicitly addressed this anxiety on the call, and they walked through the safety net built into their financial models. Even at the highly inflated $4.5 billion capital cost, the Baghdad expansion remains highly economically viable and generates a positive return on capital at a long-term copper price of just $4 per pound.
And to anchor that against reality, copper is currently trading at over $6.30 a pound.
Precisely. The margin of safety embedded in that project is massive. At current market prices, the expanded Baghdad facility will print cash.
And at $4 copper, which would indicate a severe, prolonged global macroeconomic recession, the project still covers its heightened cost of capital and generates a positive return.
Furthermore, building this infrastructure now ensures that Baghdad remains a modern, ultra-low-cost, fully autonomous, Tier 1 facility capable of supplying the U.S. market for decades to come, regardless of what inflation does in the interim.
And there is a massive hidden variable here that we need to unpack. The U.S. government is providing two massive structural financial tailwinds that make swallowing a $4.5 billion capital expenditure pill significantly easier for Freeport compared to a foreign competitor.
Absolutely. The U.S. tax code and recent industrial policy shifts are radically altering the economic viability of these mega projects. First, we have to look at the balance sheet.
Okay, what's on there?
Freeport has accumulated a staggering $6 billion in net operating losses, commonly referred to as NOLs, tied specifically to their U.S. operations.
Okay, for the retail investor who might not be a CPA, can you walk through exactly how an NOL functions and why a loss is actually a massive hidden asset?
Certainly. In previous decades, when copper prices were heavily depressed, or when Freeport was taking massive legally allowable depreciation write-offs on the heavy equipment they purchased for their U.S. mines, their U.S. subsidiary technically operated at a loss for tax purposes.
They were making money on paper.
Right. And the IRS tax code allows corporations to take those historical losses and carry them forward into the future to offset future taxable income.
Let me see if I get this. Let's run a simplified hypothetical math scenario.
Sure.
Imagine the expanded Baghdad mine is incredibly successful and next year generates $1 billion in pure taxable profit in the United States. A normal corporation without NOLs would owe the federal government roughly 21% of that, or $210 million in taxes.
A massive tax bill.
But Freeport possesses a $6 billion NOL umbrella. So when they generate that $1 billion in profit, they simply apply $1 billion of their historical losses against it. Their taxable income on paper drops to zero.
Exactly. They pay essentially zero federal income tax, and they still have $5 billion in NOLs left over for the following years. So as this massive Baghdad expansion comes online and starts generating billions in new profit, Freeport will pay an incredibly low effective cash tax rate for years, shielding their returns.
That is a phenomenal structural advantage that radically improves the internal rate of return on the Baghdad project.
And the policy tailwinds get even stronger. Under the new frameworks established by recent U.S. industrial policies, copper was officially added to the critical minerals list by the Department of Energy.
Which is huge news.
Huge. Now, because Freeport operates one of the only two primary copper smelters located entirely within the United States, they are actively lobbying the Treasury Department to qualify for the Section 45X Advanced Manufacturing Production Tax Credit.
Wait. Section 45X, this is direct subsidy designed to encourage domestic production of critical materials, right?
Correct. If the final Treasury regulations align the tax code with the newly updated critical minerals list, Freeport could legally receive a 10% production tax credit on the operating costs of their U.S. copper production.
And what does that translate to in dollars?
During the earnings call, management estimated that this specific credit could equate to roughly $500 million a year in pure, unadulterated tax incentives.
$500 million a year.
Yes. When you combine the massive tax shield of the $6 billion NOLs with the potential for $500 million a year in direct government production incentives, a $4.5 billion capital build stops looking like an inflationary burden and starts looking like a heavily subsidized generational bargain.
It is a stark reminder of how heavily the tax code and federal industrial policy dictate corporate strategy and capital allocation. Now, speaking of securing generational assets, we have to shift from domestic tax policy to international diplomacy.
Indonesia.
Yes, we have to discuss the other massive piece of management guidance from this call, the Grasberg license extension in Indonesia.
This is the highest stakes political tightrope walk of the decade for Freeport's executive team. Currently, their legal rights to operate the Grasberg mine in Indonesia expire in the year 2041.
Which to a layperson sounds like a very long time away.
Right, like almost 20 years.
But in the timeline of mining engineering, 2041 is essentially tomorrow morning. If you are going to commit billions of dollars to bore 100-meter drain holes and build subterranean robotic train systems, you need absolute certainty that the host government isn't going to kick you out of the country before you can recoup that capital.
Exactly. The timeline of capital return in underground mining stretches across decades. The massive headline news here is that Freeport has formally submitted a comprehensive application to the Indonesian government to extend their operating rights at Grasberg for what they term the life of the resource.
Meaning, as long as there is economically viable copper buried in that mountain, Freeport retains the legal right to mine it, process it, and profit from it.
And the tone on the call was incredibly optimistic. The chairman, Richard Apkerson, sounded highly bullish on the prospects of this extension.
I noticed that. He specifically highlighted that they recently signed a formal memorandum of understanding, an MOU, with the Indonesian government, and he noted that the signing was personally witnessed by the president of Indonesia.
The geopolitical dance and alignment of interests here is fascinating, and it requires some historical context. Indonesia has a strong history of resource nationalism. They want to maximize the domestic benefit of the minerals extracted from their soil.
Which makes sense.
Of course. Currently, the Indonesian government owns 51% of the local subsidiary that operates Grasberg, PTFI. They reap massive multi-billion-dollar tax revenues and dividends from this specific mine. It is a cornerstone of their national economy.
Okay, so they're highly incentivized to keep it running smoothly.
Furthermore, to appease the government's mandate to capture more value at processing within their borders, Freeport just completed the construction of a massive multi-billion-dollar copper smelter located entirely within Indonesia.
So Freeport played the geopolitical game perfectly. They yielded majority ownership to the state, they invested billions to build the domestic smelter the government demanded, and now, having fulfilled their obligations, they're asking for the permanent keys to the kingdom.
And given the sheer economic codependence, it led highly probable they will receive them.
And what does that do for their valuation?
The implications of this license extension are staggering for the long-term valuation of the company. Once that extension is formally approved and legally binding, it instantly unlocks deep exploration targets that are currently off-limits.
Because they wouldn't have time to mine them before 2041.
Exactly.
Yeah.
They have massive proven geological deposits like the deep MLZ zone sitting directly below the current active cave that they haven't even officially booked as financial reserves yet, simply because they didn't have the legal right to mine them past 2041.
Securing this license instantly and massively increases the total lifetime recoverable copper, and therefore the total lifetime value of the entire corporation.
It's a total game changer.
Okay, we have covered the massive capital requirements and the geopolitical maneuvering. Let's bring all this future guidance together into the ultimate financial metric that retail investors care about, the EBITDA sensitivities.
The fun stuff.
Management provided a detailed financial outlook, modeling the years 2027 and 2028. They expect total capital expenditures to run high, roughly $4.8 billion annually, as they heavily fund the Baghdad expansion and the Grasberg underground infrastructure.
Yeah.
But if we look at the cash generation side of the equation, the leverage is unbelievable.
The financial leverage this company has to the underlying price of copper is just breathtaking. Management ran their economic models for 2027. Assuming a baseline copper price of $7 per pound, which is highly plausible given current supply deficits, Freeport projects they will generate $20 billion in annual EBITDA.
$20 billion. And the sensitivity metric they provided is the number every retail investor needs to write down on a sticky note and put on their monitor.
What's the number?
For every 10-cent movement in the global price of copper, Freeport's annual EBITDA swings by $390 million.
I want to make sure the mechanics of that leverage are perfectly clear. The mining business has incredibly high fixed costs. You have to buy the 400-ton trucks, you have to build the smelter, you have to pay the geologists whether copper is at $3 or $10. But once those fixed costs are covered, once you break even, almost every single additional dollar generated by a rise in the commodity price flows directly to the bottom line as pure profit.
It's like operating a massive toll road.
Exactly. It costs billions to pave the highway and build the toll booths. But once it's built, if you decide to raise the toll by 10 cents, that extra 10 cents per car doesn't cost you anything extra in asphalt or labor. It is pure margin.
Because Freeport produces billions of pounds of copper, a tiny 10-cent increase in the price of the metal acts as a massive financial fulcrum, instantly adding nearly $400 million in pure profit to their annual balance sheet.
If the global supply squeeze pushes copper up just $1, from $6 to $7, Freeport adds nearly $4 billion in pure, unadulterated profit annually. That is the ultimate definition of operational leverage.
Which perfectly transitions our discussion to the final synthesis. We've seen the killer margins fueled by the gold and moly byproducts credits. We've explored the wild technological innovations like geothermal leaching and autonomous haulage.
And we've confronted the highly inflated $4.5 billion price tag for growth in Arizona and the geopolitical dance in Indonesia.
Right. Now it's time to take a definitive position. What is the actionable takeaway for the retail investor tuning into this deep dive? If you hold Freeport stock, or if you have the ticker pulled up right now considering initiating a position, how do you synthesize all this conflicting data?
Well, as objective analysts, we have to synthesize the data by rigorously examining both sides of the coin. We always start with the bear case.
Let's hear it.
If you are a skeptic looking for reasons to sell this stock or avoid the sector entirely, the primary argument is structural inflation. The 30% jump in the Baghdad capital expenditure estimate proves definitively that inflation is violently eating into their growth models.
They are fighting tech giants with infinite balance sheets for specialized labor in Arizona, and that bidding war is likely only going to intensify.
And the energy risk remains a massive volatile variable. We discussed the sulfuric acid hedge, but if the Middle East destabilizes further and industrial diesel truly skyrockets, while simultaneously agricultural demand drops and fertilizer companies stop buying the acid that pristine $1.90 cash costs could evaporate, severely compressing their margins.
And there's also a short-term trading dynamic to watch out for, right?
Yes, there is a highly specific mechanical accounting blip you need to be aware of. Management explicitly warned that their reported copper sales in Q3 of this year will artificially dip significantly below their actual physical production levels.
Wait, if they're physically mining and processing the copper, why wouldn't they sell it immediately into a $6.30 market? Why hold it back?
Because of the physics of commissioning that massive new multi-billion-dollar smelter in Indonesia we discussed earlier, the smelter just came off standby mode. You cannot just flip a switch and instantly produce refined copper.
Right, it's not a microwave.
Exactly. You have to heat the massive furnaces to thousands of degrees, and then you have to feed them a constant massive diet of raw copper concentrate to build up a molten bath within the system. It takes weeks and thousands of tons of material to fully stuff the metallurgical pipeline before a single sheet of refined copper cathode emerges from the other end.
Oh, I see. So during Q3, Freeport will be hoarding massive amounts of its own mined copper to feed into its own new machine.
Yes. This will make their Q3 sales figures look artificially weak on the income statement, which could easily spook algorithmic trading programs or retail investors who only read the headline numbers and ignore the operational footnotes.
That is an incredibly crucial nuance for the retail investor. If you see a revenue miss in Q3, do not panic and sell. They are just stuffing the pipeline of a generational asset.
Exactly.
Okay, so that encapsulates the bear case.
Yeah.
Persistent structural inflation, latent energy risk, and a confusing Q3 inventory build. Let's pivot to the bull case.
The bull case is structural, monumental, and driven by irreversible macroeconomic trends. Their U.S. business is an absolute cash-generating juggernaut right now, generating 2.4 times more operating income than it did in the first half of 2020.
And the impending Grasberg license extension permanently secures their most lucrative, cash-flowing crown jewel asset for decades to come, instantly unlocking massive, entirely new subterranean reserves.
And the technological application is astounding. They are leveraging AI-driven autonomous 400-ton haul trucks and proprietary geothermally heated chemical leaching to literally manifest the equivalent of a new Tier 1 copper mine entirely out of waste rock.
They are structurally slashing their long-term production costs without taking on the agonizing decade-long permitting risk associated with the Greenfield project.
So Bringing all of these complex threads together, my actionable verdict based on the data presented in this earnings call is clear. This is a strongly bullish signal for Freeport-McMoRan.
Right, strongly bullish.
The overarching combination of structural global supply deficits, we must remember that visible copper inventories in China are sitting at multi-year lows, combined with Freeport's highly disciplined capital return policy of handing 50% of all available free cash flow back to the shareholders, makes them arguably the premier, lowest risk vehicle in the public equities market to play the unstoppable electrification megatrend.
I hear the conviction in your analysis, but as the host, I have to play devil's advocate and push back one last time.
Go ahead.
We're talking about a company staring down a massive $4.8 billion capital expenditure bill coming due in 2027. If a severe global macroeconomic recession hits tomorrow, let's say inflation reignites, central banks are forced to hike interest rates aggressively, the AI hyperscale hype cycle rapidly cools off, data center construction pauses, and the price of copper plummets back to $4 a pound.
A true doomsday scenario.
Right. Freeport will be left holding the bag on massive multi-billion-dollar expansion projects into a rapidly shrinking global market. Doesn't this entire bullish thesis implicitly require a perfect scenario macro environment to actually generate returns?
This raises an important question. In commodity investing, you must always plan for the cyclical crash. But here is precisely why Freeport-McMoRan is uniquely and structurally positioned to not just survive, but potentially thrive in that exact macroeconomic nightmare scenario.
So
It all comes back to the very first and most important financial metric we discussed at the top of the deep dive. The unit economics.
the $1.90 per pound net cash cost.
Exactly. Because their underlying unit net cash cost is so heavily and continuously subsidized by the robust prices of gold and molybdenum, they are physically producing copper for under $2 a pound.
So even if prices tank,
If a severe global recession hits and demand destruction crushes the price of copper down to $3 or $4 a pound, the vast majority of their junior and mid-tier mining competitors will instantly begin bleeding cash. Their operational costs will exceed their revenue. They will be forced to shut down their mines, lay off workers, and halt all production, which ironically eventually fixes the oversupply issue.
but
Freeport will still be highly profitable. Even at $4 copper, a $2 profit margin applied across billions of pounds of production still generates massive, reliable free cash flow. They possess the balance sheet strength to continue funding their critical expansions out of their own cash flow, even in the depths of a severe recession.
This allows them to aggressively expand their market share and prepare for the inevitable rebound while their weaker, high-cost competitors die off.
They do not need a perfect macroeconomic environment to succeed. They simply need their byproduct credits to remain relatively stable, and they can weather almost any economic storm the market throws at them.
That is the ultimate margin of safety for a retail investor. They are the structural, low-cost producer in a world that fundamentally requires their product to function.
Exactly.
Okay, we have covered an immense amount of complex terrain today. Let's recap the vital insights we've extracted. We started with a mission to translate the dense corporate jargon of the Freeport Q2 earnings call, and the underlying reality is phenomenal. Freeport-McMoRan is a highly optimized cash-generating machine that is successfully riding the massive multi-decade wave of global electrification.
Yes, they are facing brutal 30% inflationary headwinds on massive capital expansions like the Baghdad mine. But they are systematically neutralizing those costs with incredibly smart, highly scalable technology like geothermal chemical leaching and autonomous haulage alongside high byproduct commodity prices and a brilliantly integrated smelting operation that hedges their energy exposure.
They are heavily investing in securing their domestic American footprint. They are successfully navigating complex geopolitics to secure their future in Indonesia. And they are rigorously returning half their free cash directly to the people holding the stock. It is a textbook masterclass in cycle management.
It really is.
But before we wrap up, I want to leave you, the listener, with a final provocative thought to mull over. It's something we touched on briefly during the tax discussion, but it is a concept that fundamentally changes how you might look at this specific ticker symbol. We spent this entire deep dive analyzing copper as the critical metal of green energy, the essential conductor for electric vehicles and AI data centers.
But there's more to it than that.
Much more. I want you to consider the immense geopolitical leverage that Freeport-McMoRan suddenly possesses. The United States government is currently locked in a desperate, highly strategic geopolitical battle to onshore critical mineral production and break its reliance on foreign, potentially hostile supply chains.
Which is precisely why the Department of Energy just formally added copper to the critical minerals list. It is no longer just a building material, it is a strategic necessity.
Right. And right now, the U.S. government is actively debating implementing severe Section 232 tariffs on foreign-produced copper cathodes by 2027 to protect domestic interests. If those sweeping tariffs go into effect, foreign copper becomes artificially, prohibitively expensive within the United States.
And that changes everything.
It does. Now look at Freeport's positioning. They have a massive, rapidly expanding production footprint in Arizona. They possess billions in U.S. tax shields. Most importantly, they control one of the only active copper smelters remaining in the entire country. If the U.S. government effectively walls off the domestic market with tariffs to ensure supply chain security, they implicitly guarantee artificially premium pricing for domestically produced copper.
It creates a captive market.
So the fundamental question you have to ask yourself as an investor is this. With their massive, irreplaceable U.S. footprint, might Freeport-McMoRan transition from being evaluated as a simple, cyclical mining company into a highly protected, strategic national asset?
That's a fascinating perspective.
If the federal government essentially guarantees their profit margins in the name of American national security, what happens to their valuation multiples? When you buy a share of Freeport today, are you just investing in a company that digs rocks out of the dirt, or are you actually buying a foundational stake in the invisible, heavily fortified infrastructure of American national security?
If that tariff scenario plays out, it fundamentally alters the entire investment thesis from a traditional cyclical economic play into a highly protected geopolitical monopoly.
Something to carefully consider the next time you flip a light switch, start an electric vehicle, or ask an AI a question. That invisible infrastructure is more valuable and more heavily contested than ever before.
It certainly is.
Thank you for joining us on this deep dive into the data. Keep exploring the mechanics behind the numbers, and we will see you next time.